Hello, I'm Faith Schwartz, Senior Vice President of CoreLogic Government and Public Affairs. Today we are here to talk about three different areas impacting the U.S. mortgage market with regard to liquidity and advancement in the housing and mortgage space. This discussion will explore the impact of the end investors, shifting credit profile, government programs, regulations, and current credit accessibility for borrowers across the spectrum. Mortgage credit investors. First, it's important to recognize where the mortgage market stands today compared to years past. As of the first quarter of 2015, Fannie Mae, Freddie Mac, commonly referred to as the GSEs, and the Federal Housing Administration and Veterans Administration backed over 70% of first lien originations. Meanwhile, the private label securitization market remains lackluster, having declined from its 41% market share peak in 2006 to less than 1% over the past 7 years. This is a reset of the investor mortgage market and the flow of private capital into housing. Meanwhile, balance sheet lending, or loans held by banks, has grown to 28% as of the first quarter of 2015. Overall, the U.S. government continues to be a dominant player in the residential mortgage market, and we anticipate this to be the case for some time going forward. There is little congressional momentum around comprehensive housing reform, and the GSEs and government continue to play a significant role for investors in liquidity and standard setting for the 30-year mortgage. Housing and Urban Development's FHA program, the VA, and USDA rural programs have surged and filled a void for low down payment loans. While there is much focus and activity around how to attract private label securitization so it may regain its footing, incentives for risk-taking have been greatly diminished in the post-crisis era. Under a host of new rules driven by Dodd-Frank legislation, the mortgage market has many new processes from origination through securitization and loan servicing. So how has this impacted borrowers, and what else has changed? We have seen tremendous regulatory enforcement challenges in the mortgage industry, but that is starting to slow down. We now have a good sense of many of the new rules and more clarity around industry operators who can best stay within the regulatory construct. But to fully serve the marketplace of eligible borrowers, we need to assess the breadth of origination and servicing processes for transparency and effectiveness to meet the demands of the housing finance system. Are we serving the full spectrum of borrowers in the system who desire a loan, who have the capacity and the ability to repay? Do we have the right programs and educational tools to meet the generational demands of borrowing we will see from the millennial population? Well, what we do know today is that the current credit profile of borrowers receiving mortgages for purchase transaction is much stronger than it has been in the past. This has heightened the dialogue around accessibility for consumers. Not surprisingly, since the downturn, there has been a tightening on the lower end of the credit spectrum. In 2003, borrowers with a credit score below 639 comprised 18% of purchase transactions. It was as high as 30% in 2007. The combined number of purchases today is below 4%. But that alone is not the only contributing factor to access. Most loans are now originated with full documentation. The reduction of risk layering has contributed greatly to the contraction of loans being originated in housing, with the elimination of the no and low doc loans, which peaked in 2005 at nearly 42% of those purchase originations. Today, they're less than 1%. Per our chief economist, Frank Notaff, existing home inventory supply constraints, limited affordable new construction, tight rental markets, and stagnant increases to real incomes over the previous decade all heighten barriers of access. Finally, the third key issue is the complex overlay of the Dodd-Frank Wall Street Reform and Consumer Protection Act, which had its 5-year anniversary earlier in 2015. A host of new rules have been implemented by the newly created CFPB with the intent of advancing consumer protections to ensure that borrowers who are willing, capable, and properly underwritten can attain a mortgage and eventually have home ownership. Thus far, an expansive resurgence in private participation in credit risk exposure remains to be seen. GSE temporary exemptions from ATR QM underwriting standards, varying degrees of capital standards applied to private versus government entities, and a protracted litigation environment continue to drive the dialogue in Washington on issues related to housing policy. That said, housing is on the mend. We are seeing growth in the National Home Price Index year over year. In addition, we have seen a significant decline in foreclosures and delinquencies, coupled with an extended low mortgage rate environment. With government programs dominating the role of guaranteeing credit risk, the private market will continue to be challenged to compete with the leverage of the United States government. In the meantime, the private industry, government, nonprofits, and industry trades need to work closely together to achieve the aligned goals that meet the changing supply and demand needs of all eligible borrowers. Thank you for joining me today. And please visit our website at CoreLogic.com and review our Insights page where we have blog posts and other economic reports.